Welcome to Trading Nation. I'm Mike Santoli. Stocks kicking off the week in rally mode after President Trump said he'd push back a planned tariff increase on Chinese goods. It's a development that's making one top investor even more bullish. Bill Stone is the Chief Investment Officer at Avalon Advisors. Bill, good to talk to you. Good to catch up here. I guess, spoke several weeks ago, and this rally might have been getting rolling. And here we are. S&P is up some 19%, almost 20% off of those December lows. Do you think we've gotten ahead of ourselves, or is this just taking back some of those excessive losses of December?
Well, I think it's interesting when you look at it in history. It certainly looks like we're ahead of ourselves. In terms of, really 60 days in after the low. If you look at it versus history, it is the best rally in the 60 days following the low for any time where you wasn't accompanying a bounce back accompanied by a recession. So since it's a non-recessionary time, I'll say this is as good as it gets, at least in the short run. The good news is when you kind of stick with that theme of the non-recessionary times, 1 year out after the bottom, you're typically up 28%. So I think it's time to think about being a little more defensive in the short run, but still long run, it makes sense to still stick with stocks.
And what form would that defensiveness take, do you think? I mean, is it a matter of raising cash or just maybe rotating into other parts of the market as we wait for perhaps a pullback?
I think it's more rotating over. So, give you the example of, I talked last time about semiconductors, and they just were on fire since I talked to you, or even industrials, anything that was, or most anything that had a very economically cyclical component. So I think you do kind of look for the other spots that have been left behind a little bit, whether that be, I know it's not non-cyclical, but energy. I do think when you're going to the less cyclical, healthcare hasn't been doing as well. And even, again, you can argue it's cyclical, but I do think the consumer is in good shape. So I think consumer discretionary, which hasn't gone up quite as much, is also an interesting spot.
I guess the other question as we get to this point, the S&P is right near a level where rallies have failed a few times last fall, is exactly what has been priced in already in the way of resolution of a lot of those big overhang issues, whether it be the coming trade deal, the Fed going to some patient mode, and I guess the idea that a recession is not really in the foreseeable future, at least at the moment. Have we already kind of gotten the benefit of all the easing of tensions along those fronts?
Well, I think you've gotten, obviously, the real receding of the worries about a recession in the short term here in the U.S. Certainly, I think it's hard to not say that you've gotten the benefit of the Fed really stepping to the sideline, because they've gone beyond saying they were going to be patient to even saying, hey, we might do something with the balance sheet and slow the runoff. I think more is, and again, we got some of that today, which is more of the trade deals priced in. Is all of it priced in? Probably not, but I think a lot of it, and that may be that spot that I talked about where are we maybe ahead of ourselves and we get some more bumps around the trade deal, because it's not a done deal yet. We got it extended, but again, how long it takes us to get to a final deal, and whether we get some new headlines coming across with some worries that we're going to get back into having a spat is impossible to say, but I think you have to kind of figure that into your thoughts.
Sure. And before we go, those bumps aside, you're still looking for the S&P perhaps by the end of the year to get to about 3,000?
Yeah, I mean, I think it looks good. I think the opportunity is, maybe even to the upside, in the sense that if we get some sort of benefit from the global economies turning around. I think the U.S. is, we kind of think priced in at, 2.25% growth, but certainly Europe has continued to be slow. China has continued to be slow. They've been pouring in a lot of fiscal stimulus. We'll see if it works, but there's your opportunity. So I think in the end, valuations still look pretty good.
Yeah, and that 3,000 target would get you to that 28% recovery off of a non-recessionary 20% drop you were talking about earlier, Bill. Thanks a lot for your time today. Appreciate it, Bill Stone. And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.